Markets do not move through one permanent season. Growth accelerates, inflation changes, purchasing power, interest rates shift, confidence rises and falls, and crashes expose weaknesses that prosperous years conceal. The central lesson in Ray Dalio's economic machine strategy is simple but demanding. Enduring wealth is built by preparing for different environments before they arrive, not by assuming the current environment will continue. Dalio, founder of Bridgewater Associates, spent decades studying economic cycles to understand how economies and markets rise and fall. His framework treats the economy as a machine powered by transactions, credit, income, spending, and expectations. Each part influences the others. When credit expands, spending can strengthen. When debt becomes restrictive, spending can slow. Those changes affect businesses, employment, asset prices, and government policy. This perspective matters because many investors mistake a favorable environment for a permanent advantage. A rising stock market can make concentration feel intelligent. Strong property prices can make leverage appear harmless. Low interest rates can make debt seem inexpensive forever. Yet an investment is never judged only by its recent performance. It must also be judged by how it behaves when conditions reverse. Dalio's answer was not to predict every turning point with perfect accuracy. It was to build a structure that could remain functional across different economic seasons. That structure became associated with the all-weather portfolio, a strategic asset allocation designed to perform well across changing conditions, including rising inflation, slowing growth, and severe market declines. The important idea is not a fixed list of holdings or a magical formula. It is the discipline behind the design. Instead of asking which asset will produce the highest return in the best environment, the investor asks which risks are present, which risks are hidden, and how the entire portfolio might respond when the economic machine changes direction. This is where risk parity becomes essential. Traditional portfolios are often balanced by dollar amounts. An equal amount of money may be placed into several asset classes, yet those assets can carry very different levels of volatility and economic sensitivity. Risk parity focuses on the contribution each asset makes to total portfolio risk, rather than treating every dollar as equally influential. That distinction can change the way an investor thinks. Stocks may offer growth, but they can also be vulnerable when economic expansion weakens. Bonds may behave differently when growth slows, although rising inflation can challenge their purchasing power. Gold and commodities may respond to inflationary pressure in ways that differ from financial assets. The purpose of combining them is not certainty, it is resilience. Asset allocation therefore becomes more than a technical exercise. It is a form of risk management. The investor is deciding how much exposure to accept, what kind of exposure to avoid, and how much damage any single economic outcome could cause. A portfolio should not be built around excitement. It should be built around survival, adaptability, and the ability to continue making rational decisions under pressure. For an individual building wealth, this framework begins with a clear inventory. List every major asset, debt, income source, and obligation. Then identify the economic forces that could affect each one. Would rising inflation reduce purchasing power? Would falling demand affect business income? Would higher financing costs pressure property cash flow? Would a market crash force the sale of an investment at the worst possible moment? That inventory can expose concentration that is otherwise easy to miss. Someone may own several investments but still depend on one employer, one industry, one region, or one type of real estate. Diversification is not achieved by owning many names that all respond to the same economic pressure. Genuine diversification requires different sources of return and different responses to economic cycles. Real estate can play an important role in this broader design, but acquisition should be strategic rather than emotional. A property is not automatically safe because it is tangible. Its quality depends on location, financing, operating costs, demand, legal structure, and the owner's ability to withstand periods of weakness. The right question is not simply whether a property might appreciate. It is whether ownership remains sustainable when assumptions are tested. That means evaluating real estate through multiple environments. Consider what happens if rents stagnate, expenses rise, vacancies increase, or borrowing becomes more expensive. Build reserves before pursuing expansion. Separate personal finances from property operations where appropriate. and understand the legal and tax consequences with qualified professionals. The objective is not to eliminate every risk. It is to prevent one property or one financing decision from threatening the entire family balance sheet. Entrepreneurial ventures require the same discipline. A business can create substantial wealth because it may produce income, equity, and control. It can also become a concentrated exposure to one market, one customer base, or one founder. Strategic entrepreneurship means developing more than revenue. It means building systems, maintaining liquidity, protecting intellectual property, and creating a plan for leadership continuity. An entrepreneur should ask how the business behaves when credit tightens, demand weakens, or a key supplier fails. Can expenses be adjusted? Are customer relationships diversified? Does the company depend entirely on the owner's daily presence? A venture becomes more valuable when it can operate through changing conditions. In that sense, resilience is not separate from growth. It is what makes growth durable. This does not mean avoiding risk. Without risk, there is limited opportunity for meaningful growth. The goal is to distinguish productive risk from fragile exposure. Productive risk is considered, sized appropriately, and supported by a clear reason for taking it. Fragile exposure is often borrowed, concentrated, poorly understood, or dependent on conditions that cannot be controlled. The all-weather idea also changes how people define a successful investment. A strong return is valuable, but the path matters. If achieving that return requires accepting the possibility of irreversible loss, the strategy may be unsuitable for long-term wealth. A slightly less exciting portfolio can be more powerful if it helps the investor remain invested, avoid panic, and continue allocating capital when opportunities appear. This is why crashes are not merely dramatic events in market history. They are tests of design. When prices fall, investors discover whether their portfolio was diversified in substance or only in appearance. They discover whether their debt is manageable, whether their reserves are adequate, and whether their plan was based on evidence or optimism. Preparation cannot prevent every decline, but it can reduce the chance that a decline becomes a permanent setback. The economic machine framework also encourages a separation between forecasting and preparation. Forecasting asks what will happen next. Preparation asks what must remain true across several possible outcomes. Forecasts can be useful, but they are uncertain. Preparation is more durable because it does not require perfect timing. It requires thoughtful allocation, reasonable liquidity, and a structure capable of absorbing surprises. For families, this becomes a multi-generational responsibility. Asset protection is not simply about accumulating more. It is about preserving ownership, reducing avoidable concentration, and transferring knowledge alongside assets. Review insurance, beneficiary designations, estate documents, business agreements, and ownership structures with qualified advisors. A well-chosen investment can still create problems if the legal and administrative framework around it is weak. The next generation also needs an operating philosophy, not just an account or property. Teach them how risk works, why diversification matters, how debt can accelerate both gains and losses, and why patience is a financial advantage. Wealth that is transferred without judgment can disappear. Wealth accompanied by decision-making principles has a better chance of becoming enduring. A practical implementation can begin with 3 layers. The first is stability, emergency liquidity, manageable obligations, and protection against foreseeable disruptions. The second is diversified growth, a deliberate mix of assets aligned with goals, time horizon, and risk capacity. The third is opportunity, carefully sized investments in real estate, businesses, or other ventures that may increase control and long-term wealth. Each layer has a different purpose, and confusion between them creates danger. Liquidity should not be forced to chase growth. A speculative venture should not be treated as a family safety reserve. A property should not be purchased with money needed for near-term obligations. Clear roles make the overall financial system easier to monitor and harder to destabilize. Reviewing the strategy is also essential. Economic conditions change, personal responsibilities change, and asset values move. Rebalancing is not a prediction about the future. It is a method of returning the portfolio to its intended risk structure. The review should examine not only performance, but also debt, liquidity, concentration, insurance, ownership, and the assumptions supporting every major decision. Ray Dalio's economic machine strategy matters because it replaces financial hope with financial architecture. Its secret is not that it promises to eliminate losses or identify every market turn. Its strength is that it asks a better question. How can capital be organized so that no single economic environment has the power to destroy the future? That question leads to intelligent investing, disciplined real estate acquisition, resilient entrepreneurial ventures, and deliberate asset protection. It turns diversification from a slogan into a system. It makes risk management the foundation of asset allocation, rather than an afterthought applied after trouble begins. The enduring lesson is to build for the full cycle. Prosperity will come with pressure, opportunity with uncertainty, and growth with periods of correction. Investors who understand those realities can make decisions with greater patience and precision. They do not need to know exactly what the economic machine will do next. They need a strategy capable of moving forward when the machine changes.